Hello, everyone, and welcome to today's economic presentation. My name is Trent Green, and I lead the Treasury Management team at Oakworth Capital Bank, and I will be the host for today's discussion. We have an excellent panel, but before I introduce them, I'd like to go over a few housekeeping notes. All participants are muted, and cameras will be on only for the presenters, moderator, and host, respecting everyone's privacy. Our presenters will be sharing their video while they speak. Our webinar team may send messages to participants. The chat function has been disabled for privacy purposes. However, if you need to reach the webinar team, please use the Q&A feature located at the bottom of your screen. As always, we'd love to hear from you. Our presenters will be available for Q&A after their presentations, and if you have questions, please ask them inside the Q&A feature below. The Q&A feature has an anonymous tool that can be clicked before submitting questions. The webinar will last approximately 45 minutes, and a recorded version of this webinar will be available afterwards, along with the presentation slides. I would now like to introduce you to today's panel. John Norris is the Chief Economist at Oakworth Capital, and he leads our investment committee. John hosts the podcast Trading Perspectives. He writes a weekly column called Common Sense, and he is the editor for our quarterly Macro and Market Perspectives magazine. David McGrath serves on our investment committee from our South Alabama office and is a regular contributor to our thought leadership team and our macro magazine. Sam Clement, also on our investment committee, is a portfolio manager located in our Central Alabama office. He co-hosts the Trading Perspectives podcast and is a regular contributor to our macro magazine. For those of you just joining us, welcome, and let's get started. As we turn to the presentation topic, I'd first like to introduce Oakworth Capital Bank. We provide commercial and private banking, wealth management, and advisory services for closely held businesses, business owners, professionals, and other high net worth individuals and families. Our thought leadership team is very active, sharing predictions, reflections, and insights for our clients and communities on the macro economy. I'm now going to hand it over to the thought leadership team. By the way, this will be a live panel. For the benefit of this event, John, David, and Sam will be sharing key economic takeaways you want to know.
All right. Thank you for that, Trent. And before I get going, I do have to say just one little caveat here, and that's anything that we say here today, nothing should be considered an offer to buy or sell financial services or products of in any way, shape, or form. And any decisions that you make based on what you hear today, you do so of your own risk, discretion, and volition. Now, with that being said, I'm a huge believer in you need to know where you are and where you've been in order to know where you're going. So let's just take a look back a little bit at 2023. And if you remember correctly, at the beginning of last year, everyone was worried about a recession. Everyone thought the Federal Reserve would come in, start cutting rates, and none of that happened. However, at the beginning of the year, it certainly did look like things were going to kind of fall apart a little bit, if you remember that. And in fact, in a lot of ways, I could have made a much stronger case for an economic slowdown than probably what we got. If you remember the first quarter of last year, we had a number of high-profile bank failures. Last year, M2, the most commonly used money supply gauge, fell about $900 billion. Deposits on bank balance sheets down about $750 billion. The yield curve was inverted literally all year long. And as a result, borrowing and lending and throughout the financial system really was very sluggish throughout much of the year. In fact, loans and leases on bank balance sheets grew only about 2.5%, which is significantly less than the historical norm. Then the regional purchasing managers indices were absolutely horrible last year. Things like the Conference Board's leading economic indicator gauges now been negative for like 21 consecutive months. And still, by the time the dust settled and the smoke cleared, the Bureau of Economic Analysis announced that the gross domestic product in the United States last year grew 2.2% during the first quarter, 2.1% during the second quarter, 4.9% during the third quarter. And then if the Atlanta Fed's prognosticators are accurate, it should have grown maybe around 2.4% during the fourth quarter. So all that negativity that I've already mentioned, all that negative stuff, and really, by the time everything was said and done at the end of 2023, we had a very good stock market, and we had an economy that was growing pretty nicely. So, David, I've got to ask you a question. All this stuff that we saw last year, all this negative stuff, waiting on a recession, waiting on the Federal Reserve, none of it really happened. None of it really seemed to matter. What can the economy do for an encore in 2024?
Well, John, it's interesting as we head into 24, the fear of a recession that we had as we started 23 seems to be gone. The labor market that was feared to start to weaken in 23 is still strong with an incredibly low 3.7% unemployment rate. So a lot of it hinges on the labor market. Will that continue to be as red hot as we've seen over the last couple of years? And I think as the labor market goes and as inflation goes, will kind of dictate what the Fed can do and what corporate earnings can be this year. So I think we've got to focus on corporate earnings and inflation and see how the Fed reacts to all of those.
All right, Sam, that is what oldest and older thinks. What is maybe someone from the younger generations? What do you think is going to happen?
Yeah, the easy answer, I guess, is that maybe we get a little bit more of what we've had so far these last couple quarters, but it's really going to focus a lot on, David kind of hit on it, but it's going to be the consumer is really going to be a large driver of it. Wages, unemployment. I mean, you hit on it, David. The unemployment rate is still under 4%. That is extremely tight, and there's still plenty of jobs out there available for those who want one. But the consumer makes up 70-ish% of the economy. So we are a consumer-driven economy, and the consumers remain strong really because of that. There's confidence in your job. There's confidence. You can go out and find a job if you'd like one. There's still plenty of jobs available, more jobs available than people looking for jobs. And so overall, there's still a lot of strength, and there's a lot of room for the U.S. consumer to still kind of keep chugging along, especially with wages continuing to remain strong.
Well, Sam, if wages are continuing to remain strong and the price of money in the United States is generally based on inflation expectations, if we have a strong labor market, we have wage pressures out there, how in the heck do we get to the Fed's preferred inflation numbers? I mean, after all, we'll find out later on this week with the personal consumption expenditure core deflator coming out on Friday, just where we are. But when we take a look really at inflation, and David touched on it, when we take a look at inflation throughout the U.S. economy, it's better than it was, but it's still not where anyone would like for it to be. And guys, we've all talked about it. When we say inflation is coming down, we're talking about the rate of price increase growth is slowing, right? However, what a lot of people hear is prices are coming down, and that's just simply not the case. What's the old joke? Prices go up on the elevator and come down using the steps if they come down at all. So when we take a look at inflation, when I'm looking at the crystal ball, which is right behind me, you can't see because my background is blurred. When I'm taking a look at the inflation, I'm going, how are we getting to 2%? Right now, what the trailing 12-month CPI is 3.4, if I'm not mistaken. The trailing core deflator on the PCEs, 3.2. The Fed wants that to be 2%. But we mentioned, my goodness, wage pressure, unemployment 3.7%. And we haven't even touched on things like the rental equivalency of your primary residence has been up 6.5%, at least in the CPI. And as long as inventory of new and existing homes are so low as they are, gosh, I don't see rates coming down. So, I mean, I'm sitting there taking a look at it. Is inflation really going to be the market or the economy's friend this year? Or are we still going to be scratching our head at the end of 2024 going, it just really didn't fall as much as we thought it was going to. And I'm going to do age before beauty one more time, Sam, and I'm sorry about that. I'm going to throw this, hopefully, softball over to David. David, what say you?
Yeah, it'd be awesome if core inflation came down to 2% by the end of the year. With wages going up somewhere around 4% a year, it's going to be hard, I think, to get all the way down to that 2% number. But as long as the trend it continues to come lower, I think that will be good enough for the Fed to act by the second half of the year in cutting rates to try to help the economy some. But I think, John, it's going to be a long haul to get all the way back down to that 2% by the end of the year.
All right. I mean, Sam, tell David why he's wrong or why he's right.
Yeah, he's not wrong, and a lot of it is the trouble with how it's calculated. The numbers we're talking about are a year over year number, so it involves data from 6 to 12 months ago taking part in it. So we've seen some numbers come in better over the last few months, and obviously that's something we're hoping that continues. But again, going back to it, it matters how they measure it. The rental equivalency is a big portion of it. That is coming down. We all know it's a lagging indicator, and it's probably going to continue to come down, but it's a massive chunk. It's still too high. Wages are the other thing. You hit on that. That's really strong. We've seen the services be really strong in terms of inflation. That's been the thing that hasn't really budged as much. We've seen goods come down, a lot of that being the supply chain disruptions, and that seems to have mostly normalized. But in terms of getting to that 2%, that year over year 2%, we're going to have to continue to see goods be relatively low inflation. We're going to need to see probably a little softening in the labor market to get some wages to slow down a little. And we're going to need to see housing continue to, that owner's equivalent rent portion of the equation, to continue to head lower.
Without a doubt. Now, we've talked a decent amount about the jobs market. We've talked about inflation. This is important because the Federal Reserve has a so-called dual mandate, right? And that's full employment and price stability. When we're taking a look at an unemployment rate of 3.7%, and we're taking a look at inflation gauges being north of 3%, it's kind of difficult for me to think that the Fed, without something happening, is going to be as aggressive as what the markets currently think it's going to be. In the December FOMC meeting, Federal Open Market Committee meeting, I think the dot plots, just sort of the near-term forecast for all the voting members of the FOMC, forecasted what, 3 25 basis point rate hikes over the next 12 months. And then what did the futures market do? On the Chicago Mercantile Exchange, my goodness, they said 3 nonsense. We think that they're wrong. They're going to cut 6 times next year. And right now we're kind of hovering around 5.5 rate cuts. So the Fed's telling us 3 rate cuts. The futures market's telling us 6 rate cuts, 25 basis points a piece. And yet, guys, when we're talking amongst ourselves, we're having a hard time really getting to that 6 number. I mean, we're going to have to see that inflation gauge fall pretty significantly. We're going to have to see probably much weaker economic growth than what we are forecasting to start the year, which is cool, but not a collapse. And we're going to have to see an uptick in the unemployment rate, which could happen. But even so, getting down to that, 150 basis points worth of Fed cuts, taking the overnight lending target from 5.5 to 4%, I think is going to be kind of wishful thinking, at least here as we start the year. And I'd feel much better telling folks, hey, go ahead and plan for 4 rate cuts, 100 basis points. If we get 3, okay, well, you're not off by that much. If we get 6, hey, look at this. You got more than what we forecasted. So aren't you lucky? But 4 seems good to me. I mean, it seems like a nice, easy number that I can defend a little bit more than the 6. And hopefully we do get that as opposed to the 3 that the Fed's telegraphing. Sam, what are your thoughts?
Yeah, first off, it's worth noting that both the market and the Fed have been wrong about where interest rates were going to go over this hiking cycle. I mean, it was right as they were starting, or a little bit before the Fed started hiking rates. They said they're not even thinking about hiking rates. Pretty soon after that, they started on the fastest tightening cycle in 50 plus years. And then last year, the market was wrong as well. I mean, you hit on it. The market was pricing in cuts last year. The data kept coming in strong, and there was really no reason for the Fed to start cutting. So the market was wrong last year. And again, you hit on it. There's a big difference between the two right now. With the Fed saying 3, the market saying at any point in time 5 to 7 rate cuts. Those two are probably going to have to start coming together at one point. And you're right. It's going to either be, if they're getting to 6, 7, it's going to be weakness in the economy or inflation running essentially at 0 and them starting to be concerned about deflation, not just disinflation, but full on deflation. So
there's some people that are dealing in certain types of goods and products that are already seeing deflation. in their industries due to inventory overhang and just luxury goods really being kind of sluggish in some sectors. Even so, we are still seeing, inflation kind of percolate amongst services, as you mentioned, the rental equivalency. And by the way, has anyone repriced their car insurance recently? I swear they're trying to get me to eat ramen. Now, David, what do you think about what Sam just said in terms of the number of rate cuts? You and I've talked, feel pretty good about 3 to 4. I say 4.
Yeah, no, I think if we get 6 rate cuts or more, I'm not sure that's a great recipe for stocks because at some point, and John, you'll remember this, it wasn't 10 years ago that 4% would be considered full employment and almost impossible to get to. And so being at 3.7% unemployment with an inflation rate that's still 50% or more above kind of the Fed's target, I think we're going to have to see significant weakness in the labor market with inflation coming down. And I think if we get that, I don't know if that is great for corporate earnings. We had a great year in the stock market last year, but corporate earnings are going to be basically flat year over year from 22 to 23. And we're not really optimistic for a great year in corporate earnings this year. So if we have something go wrong where it forces the Fed to cut interest rates 6 times or more, I'm not sure that's necessarily going to be great news for the market. I think the soft landing that the Fed is trying to bring home would be great if we got 3 or 4 and we still had maybe a 3, 4, 5% earnings growth year over year from 23 to 24. I think that's, kind of the best case scenario for the markets.
Well, speaking about the markets, market rallies tend to have 1 or 2 things in common, or sometimes a combination thereof. And one is earnings growth, particularly strong earnings growth, and then multiple expansion. What investors are willing to pay for in terms of corporate profitability. Oftentimes, you'll get that market expansion when interest rates are going, that multiple expansion when interest rates are falling, typically during a Fed cutting cycle. We didn't have Fed rate cuts last year, but we saw the market explode despite earnings being so-so, which suggests multiples went through the roof, and they did on some stocks. So if we didn't get the rate cuts last year, but we're expecting them this year, did the market steal some of 2024's performance, particularly during the fourth quarter of last year? And if the markets did steal some performance from last year, or if last year's markets stole performance from this year, what can the markets do really for a repeat? Should we be expecting another 24% out of the S&P 500, another 35% out of the NASDAQ, when, my goodness, we've already seen the multiple expansion and the economy is going to be decent, but probably not enough to cause corporate profits to surge significantly. Sam, I'm going to let you take the first stab at this one.
Yeah, it's worth, I think, for talking about what happened last year, breaking it up into the first 10 months and then the last 2 months. But you're absolutely right in that, especially for the first 10 months, the market was led by a handful of names. And really, even then, it was driven purely by multiple expansion. That's kind of a tough act to follow, to have back-to-back years of pure multiple expansion leading the market. But David hit on it with if we can get a decent mixture of earnings, maybe obviously better than last year's basically flat earnings, and rate cuts for the right reasons. And I think that's an important asterisk. If we're getting rate cuts just because inflation's coming down, even if the market's strong, they're able to bring rates down. That's kind of that combination. I think you get a better mixture of, maybe not a ton of multiple expansion, maybe a little bit or holding steady, maybe up 1 or 2 ticks, and then the rest coming from a little bit of earnings growth.
All right, David, that seems to make a lot of sense to me. I mean, you feeling any different?
No, I think, maybe the best way to think about it is the rally we saw in November and December of 23 was a great year in 24. I mean, so I do think the market, anticipated the rate cuts that we're going to get this year, and we saw the rally from that. But if you look, 2023 earnings for the S&P will be about $220. If we put a 3 or 4%, increase in earnings, That puts us at about 21 times earnings right now on the S&P 500. And so we might be able to get, and I think Sam was alluding to this, we may get to 22 or 23 times earnings on that, which would give us, a decent gain this year. I think you also have a scenario where the first half of the year may be somewhat choppy. We had that big rally at the end of last year. We still need inflation numbers to come down. And we also have a presidential election this year. And so the markets don't like uncertainty. This could be a rather unusual election. But at the end, the markets can do okay in any political scenario, but at least they will have certainty come November. And so I think we may see most of the move up this year coming in the last quarter of the year, the last 5 months of the year, something like that. So I think we may be somewhat flat in the beginning of this year, but then we can still have a decent rally at the end of the year. And you throw a 1.5 or 2% dividend yield on that, you could have a 7-8% return for the S&P this year.
Well, this is a point of the program where I do have to say we are not going to touch on the presidential election. We're trying to avoid that as much as possible. Mama always told me, do not talk about religion and politics and mixed companies. So we're going to stay away from those. However, I do want to kind of go back and talk about the stock market a little bit and just point out the obvious. Really, since 2009, all you had to do was be in tech or communications to some degree. After they redefined what was in communications, all you had to be was in tech. Large cap growth for all intents and purposes for the last 15 years, and you would have done pretty doggone well. 2022 may be a little bit of an exception, but last year we saw tech and large cap growth just absolutely shoot lights out. So when we take a look at things and understand that a huge chunk of the return in the markets last year came from a select number of names from a couple of primary economic sectors, the market was not necessarily broad-based, as we would like to say. Can we expect tech and growth to continue to outperform as much as they have in recent memory? And if not, what looks good in this environment where we see okay economic growth, we see 3, maybe 4 Fed rate cuts, and hopefully when that happens, we'll see the yield curve maybe not be steep, but be no longer as inverted as it has been. What works in that type of environment? Is it the same old that we've been experienced for the last 10, 15 years? Or is it something a little bit different? Sam, your thoughts?
Yeah, you hit on it and going back to where that multiple expansion was coming from, the market was led by multiple expansion, but that again, it was really in those 7 names. So when we're talking about where we can get some multiple expansion that can help the markets, it can go back to that. There were 493 other names in the S&P 500 that really didn't have that same amount of multiple expansion. So I think a broadening out is what kind of makes sense for next year. And that doesn't even mean that next year is one where tech does poorly, and it could still outperform a little bit. I think the main message is that a market where rates are coming down for the right reasons, there's a little bit of earnings growth. We can see a lot of these names that have been punished for really 2 years start to have some multiple expansion, start to have some earnings growth, and just have a much healthier, broader market. I mean, 71% of names underperformed the S&P 500 last year. That's pretty close to a record high, and it's a very abnormal year. And until November, it was even higher than that. So we had a very narrow market of names contributing. And I think this broadening out beyond tech, beyond those communication names, and even outside of just large cap names is something that can really make sense next year.
All right, David, I mean, you're the old portfolio manager on the mid-cap growth fund at Regions Financial Corporation. You love growth. You love tiny PEG ratios. You prefer technology stocks. Tell me what Sam said that doesn't sound correct. I mean, is tech going to continue to just absolutely throttle the remainder of the market?
Well, I would love to disagree with Sam, but I'm not going to be able to. I think if we think about this, John, if you go back really from the financial collapse in 2008, interest rates have been basically at zero with Fed funds rate. That is a much better environment for growth stocks because they're not paying dividends, and it really doesn't matter because you're bringing back future earnings and you're discounting them at a very low number. Well, when you're discounting those at a much higher number, those valuations won't be as strong. I think what was really interesting about last year is after we had some of the bank failures in March, the rally that we had after that wasn't in the bond market. It was in those really solid, large tech companies and communication companies that people have become very comfortable with. And they have been great provider of earnings, very, very stable earnings. And it was almost a safety move into those names. But I think those valuations now are at a point where it doesn't make a lot of sense to expect another 40, 50, 60% move up in these names. And as we have a lower return expectation across the board, I think investors will be more comfortable buying more of the value names where you can get a 5, 6, 7% change in stock price and you get a 3 or 4% dividend yield on top of that. That sounds pretty good in an environment where you think the total return is going to be a little bit lower. So,
well, particularly with some of those companies where you don't have to explain what the business model is. So that's what you have to do with some of these tech names, as you well know. But you mentioned interest rates, and we've pretty much made it clear that we think short-term rates are going to fall at least somewhat next year. But what about longer-term rates? And that's kind of what the price of money is in the U.S. economy, longer term rates, the 5-year, the 10-year, the 30-year treasury. And when I take a look at things, really the historical sort of yield to maturity or total rate of return on intermediate term treasuries, according to Ibbotson, is around 5% going back to 1926. Currently, the 10-year is what, 4.2, something like that? Got less than 2, hit 5% during the fourth quarter of last year. When I take a look at short-term rates, I think it's a given that they're going down. However, the longer-term rates, I'm still a little bit got a question mark over my head, if you will, because I don't see how they fall dramatically if they maintain their historic spread over inflation. And then, by the way, we're going to be borrowing a ton of money over the next 12 months. And it does come down to supply and demand. There's an inverse relationship between interest rates and bond prices. And it's just good old-fashioned math. Interest rates go up, bond prices go down. Now, if you think back to your supply-demand curve graphs from Econ 101, the Treasury's dumping all the supply onto the markets. In order for prices not to fall, and therefore interest rates to go up, we're going to have to see an increase in demand from bond investors for all intents and purposes. I know I'm getting a little arcane, a little bit down in the weeds. Basically, when push comes to shove, I've got a real question on how interest rates can fall significantly on the long end when the Fed is going to be throwing, literally hundreds of billions of dollars probably out at the long end of the curve. And that should put an upward bias or pressure on longer term interest rates as we just kind of struggle to find the demand out there. After all, understanding that the Federal Reserve and foreign investors have really kind of backstopped the bond market for the last, since the financial crisis. And if the Fed's going to be shrinking its balance sheet at the same time that the Treasury is increasing its supply of issuance, Sam, how do we keep longer term interest rates as low as investors would like?
Yeah, it's a harder story to tell, and you hit on it, just the amount of supply we're going to be seeing next year or this year. We're expecting right now close to $2 trillion of new issuance from the Treasury. That is a massive amount of supply, and you also hit on a lot of it being on the longer end of the curve, and I think that's an important characteristic of it is where are they issuing this? The market can digest tons and tons of Treasury bills. It's essentially the risk-free rate. The market can take those in, not really a problem. Starts to be a problem when they have to issue more notes and bonds further out on the curve, 5, 10, 30 years out, where that supply demand really starts to take effect. And you're right, that massive amount of supply that we're going to see this year, it's hard to envision that not having a massive impact on where rates go.
All right, David, talk me off the ledge here. Here I am. I'm being a little bit of a Debbie Downer here. Towards the tail end of the webinar, talking about interest rates being higher than we would like.
I think that's going to be the most interesting story over the next couple of years. If you think about the $33 trillion in debt we have as a country, about half of that, thank you, about half of that comes due in the next 4 years. So, that's going to be about $1 trillion a quarter that has to be reissued by the Fed. And I think or by the Treasury. It's going to be difficult to see interest rates come down. I mean, may stay flat, but I kind of agree with you. I think there's going to be an upward bias. And if we see the short end of the yield curve start to move down as the Federal Reserve lowers interest rates in the second half of this year, we could get back to a more normal looking yield curve, which is really good for financial stocks and which is really good for banks wanting to make loans. All of a sudden, if that spread between where they pay depositors and where they can make loans, that number grows, banks want to make more loans, and that's usually pretty good for the economy. So there's a give and take with what happens on the longer end of the yield curve.
All right. Now, when talking about the longer end of the yield curve, a lot of my negativity comes from the fact that for long years, the Fed was increasing the size of its balance sheet, typically by buying government debt, right? I mean, we took it from less than about $800 billion in 2007 to I think we're almost topped up around $9 trillion. The Fed has been shrinking that. Sam and David, this could be kind of a toss-up question for you all. The way that I view things, and you guys tell me if I'm wrong, if longer-term rates start backing up in a worst-case scenario due to all this Treasury supply, that's my hand going interest rates, if they back up, do you think that the Federal Reserve will stop its quantitative tightening, start buying debt again? If not that, to that degree, do you think that it will start maybe doing a twist or something like that and buying securities on the longer end of the curve to artificially keep interest rates down? I think that's going to happen. I think that's probably going to happen by the end of this year. It will be kind of quietly announced, but I don't see any way that the Fed can continue to shrink its balance sheet, the Treasury issue as much debt as it's going to, without seeing interest rates go up. And as a result, we're going to rely on the Fed again in order to keep interest rates artificially low in some form or fashion. Last time is on the short end. This time I would argue it's going to be on the longer end. Guys, tell me I'm wrong.
No,
I don't.
I think you're probably right, John. And I think what that's going to take off the table is the extreme move up in interest rates. I think, they're not going to be able to bring rates down. I don't believe, but I think they may be able to keep them where they are or a slight move up rather than a dramatic move up if they didn't intervene.
Sam?
Yeah, the Fed we've seen this playbook before. When they say they're going to normalize their balance sheet, they normalize it at a higher level, which I would argue isn't really normalizing it. But that's kind of the playbook. And we've already seen some chatter from Fed officials, all those speeches they do that we kind of listen to. They've hinted at, as the reverse repo, and not to get too into the weeds, as that starts to dwindle down, there's going to be a change in Fed's policy. I feel pretty confident that by the end of this year, I know, John, you and I had talked about probably closer towards the summer, we're going to start to see the Fed changing what they're doing, whether it's a full-on change in their quantitative tightening, how much they're letting roll off, what have you. We are going to see a change this year.
Yeah, and that should impact the residential real estate market, which has really just been taken out back behind the woodshed and beaten up over the last couple of years. As essentially we've gone from mortgages down at 30-year fixed at 3.25% to getting over 7% at times over the last 18 months, finding a home less than 7% now. And good Lord willing, and the creek doesn't rise, and that's a nice Southern expression. Some rate cuts might bring the longer-term mortgage rates down closer to maybe a 6 handle. But if the 10-year is backing up from 4.5%, 5%, we're probably not going to see those mortgage rates dip too significantly lower. But even so, is that little bit of improvement in mortgage rates going to be enough to help drag residential real estate out of the doldrums, understanding that I think recently existing home sales hit like an all-time low. I mean, or something absolutely ridiculous. I've told real estate groups we will see improvement, just not as much as we would like to see next year. And I think that has a lot to do with interest rates. But I do think we're going to see a slight improvement in residential real estate, which should be obviously much better than the alternative, and should make homeowners feel a little bit better about things. David, what are your thoughts on that?
Yeah, I think two things are going to help the housing market. And one is the longer we go on with 6-7% mortgage rates, that kind of becomes normal. You know,
Yeah.
everyone got used to the 3 and 3.25. I'm going to wait till we get a better rate. Well, the better rate may be 6.5. And the other thing, people are going to have families. People are going to want to downsize. People are going to move locations for jobs. So you're going to have people starting to move just because life goes on, no matter what interest rates are. So I think you can have some thawing of the residential housing market, which I think is going to be a good thing. And we've proven in the past we can have a pretty nice economy with a 6.5% mortgage rate.
Yeah, Sam, I mean, what are your thoughts? I mean, here you are, you're the youngest of the three of us. I'm not sure if people can tell by looking at your picture, comparatively speaking. I'm the oldest, and I'm not sure if people can tell by that. So for me, sitting around talking about 6.5% mortgages, yeah, it doesn't sound all that crazy to me. However, for a guy your age, I mean, my goodness, that's a doubling of where mortgage rates have been most of your adult life. Do you think that these higher rates are going to scare away Gen Z?
Look, time heals all wounds, and I think David kind of hit on that in the sense of, people are still comparing to 2 3/4, 3.25, that range for where mortgage rates are. But the further we get away from that, the less we're anchored to that, and the more we're anchored to, they were just at 8, 6.5 doesn't sound that bad, or they were at 7, 6 doesn't sound that bad. And then it begs the question, does that open up more people that have been waiting to sell their house, or more people waiting to buy buy a house? But overall, I think as we start to normalize, unanchor from those just abnormally low mortgage rates, we're going to see a more normalization of the real estate market. And again, especially with real estate, it's just such a local thing. You're seeing extremely different markets in areas like South Florida, California, Dallas, anywhere in Texas. Really, it's such a localized market that it's all going to depend on location.
All right, one last sort of comment or commentary on our end, open up maybe for Q&A for about 5 minutes. And my last sort of statement and with observation has been, what we've seen really over the last 24 months. It seems to be a lot of geopolitical turmoil, and so when we see that happening, increasingly appears to me, and Sam and I've talked about this quite a bit, there's going to be a growing divide between the global north and the global south. And if you aren't familiar with those terms, the global north is sort of what we used to refer to in a simpler age as the first world and certain second world countries. And the global south is the third world. And moving forward, when we take a look at things, I expect this sort of tension between these two groups to continue to grow up. To continue to grow, just due to the fact that really the global north set the rules for the global financial system and the global economy and didn't get a lot of input from the global south, really, if we're being honest with ourselves. And now as these economies have grown significantly, as places like China, India, Indonesia, Malaysia, host of others, as they have grown in importance both economically and militarily, what do you see happening over the next 10, 20, 30 years as the global south flexes its muscle a little bit? Sam.
Yeah, you're right that we have talked about this. And I think it's going to be what we've seen over the last 5, 10, 15, 20-ish years. And that we're going to see, a lot of these emerging market, global south countries are really invigorated right now. Their economies are growing right now. They want a seat at the table. And I think this is something that we're going to continue to see. I don't think it's going to be this worst case scenario. I mean, we've talked about it in the sense of the US dollar being the reserve currency. That's not going to change anytime soon. But I think with that, we're going to see the same with global superpowers. We're going to see a slight shift away, this continued drift away from the United States, with the United States still being the overall global superpower. I mean, there's still nothing that compares to the United States right now. There's nothing that compares to the US dollar. So it's not that worst case scenario, but it's this continuous drift away, especially for some of these emerging market economies that are growing and turning into developed economies and not having the same seat at the table as the rest of the G7.
All right, David, what Sam said just made a lot of sense to me. Tell me we're wrong.
No, I agree 100%. I just think it's going to be a very gradual move. And I think it may take 15, 20, 25 years before you look back and go, God, U.S. has kind of lost a little bit of its power. And I think some of that also is going to tie back to that 33 trillion in debt. Maybe we're not going to spend as much money in the next 20 years to be kind of the world's policeman.
Fair enough. Now it's time for the Q&A, and we've already had one come across. What are our thoughts on municipal bonds and what durations to target? Let me start by saying, in terms of me, just taking a look at municipal bonds, I mean, that's how I started off my career up in Baltimore, Maryland, is managing and trading muni bonds. What people don't seem to realize oftentimes when they're buying muni bonds is they're buying a credit, and people got fooled with municipal bond insurance for long years. Even so, you are buying a credit and it'll behave like a corporate in a lot of ways. And so when you're buying a muni bond, you need to do actually your credit work, and you also need to make sure that you have a decent trading name out there. In terms of municipal bonds, you can buy these things and it might look attractive, but if you ever need to sell, you're just not going to get a bid on them. And the smaller the lot size, the more you're going to get picked off on the other side of the trade. So typically, we don't like to buy anything less than 100,000 lots for our clients when we're buying muni bonds, and typically we'd like to buy a little bit larger than that just to ensure that we have adequate liquidity when we go to trade them. While people say, I'm just going to buy these and hold them to maturity, I've generally found that's not always the case, if you catch my drift. And in terms of maturities, historically, I don't like to go out much past 15 years in terms of final maturity. And if we do have to do such things, I mean, then I start focusing on duration, and durations around 7 to 9 years is about where I feel comfortable. David?
Yeah, no, I'd agree. And the other thing to keep in mind with muni bonds, different than treasuries, is municipalities can't print money. So when you do have a real downturn in the economy, muni bonds act very differently than treasuries.
Yeah. All right. Sam, I'm going to let you kind of tackle this one. Thoughts on the emerging markets, specifically China, giving real estate sector, youth unemployment, and manufacturing production. I hope you have brushed up on your knowledge of the Middle Kingdom, because you're going to answer that one, big guy.
Yeah, and we've kind of had a position on China for the last couple of years. Places without strong individual property rights, the rule of law, things of that. It's really hard to have an economy that then rewards shareholders as well when you're talking about the markets. And, we saw some canaries in the coal mines in the last couple of years, where some of the largest companies there, after their earnings reports, they were focused on how they were helping to implement state policies and the money they were spending on state policies, which is not something you would expect out of an earnings season in a country where these are legitimate hundreds of $billion companies, to see them not focused on their company and their profits and their earnings, and instead focusing on state policies.
Yeah, that's a good answer. Now, there's another question that's come up: is the 60-40 portfolio still viable in 2024? Last year, when everything went to much warmer climes in a handbasket, and pretty much bonds were negative, treasuries were negative, stocks were negative in 2022, all that stuff, the 20-40 portfolio looked like it was DOA. I'm here to tell you that reports of the demise of the 60-40 portfolio have been greatly exaggerated. Over time, really a 60-40 portfolio or a 70-30, whatever the portfolio mix is nothing more than diversification and adding asset classes which historically have been non-positively correlated. So the more asset classes that you can add in your portfolio, the more you'll be able to reduce your portfolio's risk and hopefully increase your portfolio's return. So the 60-40 portfolio might not be generating the nice consistent 8%. For the time being, but at the same time, diversification is still a key way of reducing your risk and generating return. And I would say don't pay attention to all those people saying the 60-40 portfolio is completely dead. It is if you don't diversify correctly. David, what are your thoughts on that?
No, and I think actually with interest rates being so low for the last 20 years, the move up in rates may make the 60-40 portfolio a little more dynamic than we've seen over the last 20 years. And then finally, there was another question here. Rally in the stock market was led by 7 tech companies. Do we see a broader market rally? And the quick answer is yes. We saw that in the rally we had in December of 23. And if we talked about that multiple of 23 on the S&P 500, you take out those 7 names, that number goes down somewhere between 15 and 16. So there is some decent value in some stocks out there. And I definitely think as we move through 2024, we'll see a much broader rally than we saw in 23.
All right, one more question, and then we need to shut things off, given the time constraints. And the last one is, when will I know it's time to start investing my cash? Well, with 5% plus rates on liquidity. When the Fed starts cutting the overnight lending target, you won't be getting 5% on your cash any longer. That's as sure as the nose in my face. It's going to be almost a perfect correlation. Fed starts cutting rates 25 basis points at a clip, your cash is going to go down at almost an identical amount. So when that starts happening, interest rates start falling on the short end, yield curve starts to be positively sloped. That's when you need to start investing your cash. However, if you wait until that last minute in order to do so, you've probably already missed at least one leg up on the rally or potential rally. So don't get too used to the 5% rates. If we're correct, by the end of this year, you'll be getting paid 4% or even less. Sam or David, tell me I'm wrong.
No, and I think an important part is there's an opportunity cost with cash. So it's a matter of focusing on what the purpose of the cash is as well. Because a year like last year, even at the start, you were still getting a pretty good return on cash. By the end, you were still getting 5%. But we've talked about it. The markets were up 15, 20, 30+%. So I think it's a matter of focusing on what the intent of that cash is. Longer term expectations, markets are going to outperform cash over a longer time horizon. But short term cash, I think it goes back to that 60-40 as well. This is actually a pretty good time for that and short term assets where you're actually getting a return on it.
All right, we just got told from our webinar administrator, we got time for one more. And let me go to this one. Does the investment team have plans of adding alternative assets to the portfolio, such as Bitcoin or real estate? In terms of cryptocurrencies, just in general, probably not. At least not right now. That's not to say that we will never consider cryptocurrencies or blockchain assets. It's just a question of how do we value them. Sam and I recently did a podcast on that in terms of crypto. I think we called it Crypto for Grandma. Because as we all know, recently the SEC approved retail Bitcoin or cryptocurrencies funds for just general use. Part of the reason for it is it's neat technology. I mean, it's here to stay. Blockchain technology is. It's going to change how we conduct businesses and ultimately how we live our lives. It's just how we value the asset class. Cryptocurrencies really aren't currencies in my estimation. No one's going to go to the Citgo station or the Chevron station and buy a 6-pack of beer with their Bitcoin because they own their Bitcoin because they think it's going to go up in price. So why do you want to take something that you think is going to go up in value to buy something that's immediately consumable or will depreciate? And then also store value, which is another characteristic of a currency. That doesn't really meet, these things don't meet that terribly much either, the way that they have fluctuated so dramatically in price. As a result, not really a currency, which means that it's an asset class or an investment security, and the valuations are all over the place. And truly, how do you value something that has no cash flow? It's not even really, for all intents and purposes, real. You can't feel it, touch it, smell it, or anything like that. And right now, we're just continuing to be in sort of an exploratory or discovery period on exactly how to value cryptocurrencies and blockchain assets just in general, including NFTs. And what we will eventually see is this will smooth out as people get used to it. The flows become a little bit more normalized, a little bit easier to buy these securities, and we'll ultimately see the rate of return on these things probably be someplace in between, probably not unlike a preferred bond or something like that, just with a lot more volatility. And then you start buying those things just really in anticipation of a weak currency, and then you treat it almost like a commodity play. Understand that it's going to be a little bit more volatile than gold. Sam, David, what are your thoughts on, say, real estate or alternative assets?
No, I think you're right. There has to be some focus on the what backs up the asset, and that's an area I think we don't have a good answer with. As far as real estate and other kind of real alternatives, I think a lot of that depends on where real rates go.
Yeah, David?
Yeah, I think that sums it up.
Yeah. All right. With that, Trent, we've already gone over 5 minutes, so we're going to turn it back over to you all. Everyone, thank you so much for listening and participating today. And as always, if you have any questions, please let us know. Trent.
All right, John, Sam, David, thank you for the insightful discussion. Great information as we start 2024. As always, we appreciate everyone joining us today. And if you do have questions and you would like to speak directly to John, Sam, or David, please contact them. As a reminder, this is a recorded version, so that is available upon request. And if we can help you further your success in 2024, please reach out to us directly. As a reminder, we've got Trading Perspectives magazine, which is available anytime that you need that upon request. Also, you can visit our website at www.oakworthcapital.com and register for Common Sense, Trading Perspectives, and other thought leadership pieces. Please like us on Facebook and LinkedIn. Thank you all.